Usually an earnings report is, just a snapshot.
Right.
You crack open the filing, look at the top line for revenue, glance at the bottom line for profit, and, well, you basically have your narrative.
Exactly.
The numbers are either up, meaning the strategy is working, or they're down, meaning it's time to panic. And it's comforting because it's binary. We like our investments to fit neatly into winning or losing buckets.
Oh, absolutely. I mean, it's just the way human psychology works, especially in investing.
Yeah.
We crave that immediate categorization to justify, holding a position or just cutting our losses.
But then you look at this latest quarterly filing from Charter Communications, ticker symbol CHTR, and that crisp photograph looks like this massive double exposure.
It really does.
It's like a financial optical illusion. If you focus your eyes on one set of line items, you see a legacy telecom giant in a terrifying secular decline, just bleeding its core customers.
Right, the dinosaur narrative.
Exactly. But if you shift your focus just slightly to a different set of metrics and the management guidance,
which a lot of people skip over.
Right. You see a company quietly setting the stage to become like the single most lucrative free cash flow machine of the decade.
Yeah, the divergence between the surface level narrative and the underlying mechanics of this specific quarter, Q2 of 2026, is just unprecedented.
It's wild.
It really requires tearing the numbers apart down to the studs to figure out what is actually happening in the dirt, on the balance sheet, and in the market.
And that is exactly what we're doing today. Welcome to the deep dive. We are bypassing the usual fluff and taking the dense, jargon-heavy Q2 earnings call from Charter, and we're translating it into a highly actionable, data-forward breakdown just for you.
Because if you just skim the headlines coming across your trading terminal, you are going to get whiplash.
Seriously. Our mission here is to strip away the noise and the corporate spin, figure out if this optical illusion is a trap or an opportunity, and give you a definitive verdict on the stock. So we're doing the talk tickers format today.
I love this format.
Yeah, it's great. We'll hit the headline numbers, uncover the real story behind them, look at management's massive guidance, and give you the bottom line. Okay, let's unpack this.
Let's do it.
Let's dive straight into the raw numbers. Because on the surface, the top line trajectory is genuinely scary for anyone holding this stock.
Yeah, it's not pretty.
For Q2 2026, total revenue was down 1.7% year over year. Adjusted EBITDA, which is essentially the purest proxy we have for their operating cash flow, was down 4.3%.
Right.
And then we had the metric that algorithms and Wall Street analysts absolutely obsess over, internet subscribers. They lost 172,000 internet customers in a single quarter.
And just to add some context there, that is a steeper loss than they experienced in the same quarter a year ago.
Yeah.
So it accelerates the negative trend line.
Right. So you look at that shrinking revenue, shrinking profit, shrinking core customer base, and your gut reaction is to just hit the sell button.
Totally.
The immediate assumption is that the cord-cutting apocalypse that completely destroyed traditional linear television has finally come for the broadband pipe.
It feeds perfectly into that prevailing bear thesis,
Yeah.
that legacy cable companies are just dinosaurs waiting for the meteor. But this is exactly where you have to understand the accounting mechanics dictating those headline numbers.
Because the numbers are lying to us.
Well, the noise in this quarter was absolutely deafening. And if you don't adjust for it, you are trading on phantom data.
So let's unpack that 1.7% revenue decline. I was looking through your notes on the footnotes of this earnings release, and this drop is heavily distorted by something called a programmer app allocation.
Yes.
And it accounted for almost $250 million in this quarter alone.
$251 million, to be exact. And this is a classic example of accounting rules obscuring operational reality.
How so?
Well, to understand this, you have to look at how Charter is trying to save its video business. They are striking deals with companies like Disney and Paramount to include ad-supported versions of streaming apps like Disney Plus directly into certain cable packages at no extra retail cost to the consumer.
Okay, so if I have a specific Spectrum TV package, I can just log into Disney Plus on my smart TV using my cable credentials, and I don't pay the standalone $8 or $10 a month for it.
Precisely. It's a fantastic retention tool. But the accounting standards, specifically revenue recognition rules, are incredibly strict about how you account for bundled services.
Right, the accountants always ruin the fun.
They really do. Because Charter is delivering a distinct, identifiable product, the streaming app, alongside the traditional video feed, the rules require them to artificially allocate a portion of the customer's total monthly bill specifically to that app.
Meaning they have to pretend on paper that the customer bought the app separately even if the customer just views it as part of their one giant cable bill.
Exactly. And they have to record the cost they pay to Disney as an expense while shifting a corresponding amount of residential revenue out of the traditional bucket.
So it's just moving money from one column to another.
Yeah, and last year in Q2, this allocation was only $67 million. This year, because they've aggressively expanded these streaming deals to hold on to customers, the allocation exploded to $251 million.
Wow. So it creates a massive accounting distortion. The money is still flowing through the ecosystem, but because of where the accountants forced them to categorize it, the headline residential revenue looks like it fell off a cliff.
Yes. If you remove the volatility of their advertising revenue, which is, always cyclical, and you back out that purely accounting-driven app allocation, the actual organic revenue for the company was only down 0.8%.
Which is a huge difference. A 0.8% drop is practically flat.
Right.
It's certainly not the panic-inducing freefall that a 1.7% drop alongside a 4% EBITDA drop implies when you see it flashing red on a trading terminal.
Exactly. It's a story of hidden resilience. They are stabilizing the base. In fact, if we look at the video side, the side of the business everyone assumed was dead on arrival, their strategy of bundling these apps is clearly working.
It's a Disney Plus thing.
Yeah. They only lost 21,000 video customers this quarter. Compare that to the 80,000 video customers they lost in the same quarter last year.
Wait, really? That is a massive year-over-year improvement for a product category that is supposedly in terminal decline.
What's fascinating here is how the narrative completely flips when you take your eyes off the legacy products and look at the mobile segment.
Oh, the mobile numbers are staggering. We are talking about 406,000 new Spectrum mobile lines added in a single 3-month period.
Which is huge.
Yeah, that is 16% year-over-year growth, pushing their total mobile base to over 12.5 million lines. I mean, they are organically growing a massive wireless business right under the noses of AT&T and Verizon.
They are the fastest growing mobile provider within their geographic footprint, bar none.
But, okay, let me push back on this for a second, because this is the crux of the debate on Wall Street right now. I look at this strategy, massive mobile growth, paired with broadband losses. And it feels like they're running a high-end restaurant where they're practically giving away the heavily discounted mobile lines like a loss leader just to keep people in the building.
I see where you're going with this.
Because they operate as an MVNO, right? A mobile virtual network operator. They rent the actual cell tower capacity from Verizon.
Oh, right.
So the margins on those rented mobile lines cannot mathematically make up for the loss of a pure high-margin home broadband customer. So isn't this mobile growth just a flashy distraction from the 172,000 internet customers walking out the door?
That is the most important question to ask, and it is the exact tension driving the stock's current valuation. To understand why management is willingly leaning into this dynamic, we have to look at the physical reality of where they are operating.
The map.
Right. Charter is not a monolith. The geography of their network dictates their strategy. And right now, there is a severe divergence between their rural build-out and their mature urban markets.
Okay, let's dig into the dirt on this. What is actually happening with their physical infrastructure out there?
So Charter has been undertaking one of the most aggressive rural expansion projects in telecom history, heavily subsidized by government programs like the Rural Digital Opportunity Fund, or RDOF.
Got it.
They are physically trenching fiber and running cable to homes that previously only had access to, like slow DSL or satellite internet. In Q2 alone, these subsidized rural passings grew by 127,000 homes.
So they basically built the infrastructure to reach 127,000 brand new potential customers who have never even been able to buy Charter internet before.
Correct. And in those newly built rural areas, they generated 47,000 net new customer additions.
Oh, wow.
Yeah, that is an incredibly high take rate for a single quarter. It means when Charter shows up in a town that has been suffering with dial-up speeds, people are practically throwing their wallets at the installation trucks.
Makes sense.
The underlying demand for their core product is fiercely strong, where there is no modern competition.
But wait, if they added 47,000 new customers in the rural markets, that means the bleeding in their established urban and suburban markets is actually much worse than the headline 172,000 loss suggests.
Yes, the math is brutal there.
To net out at negative 172,000, they must have lost nearly 220,000 customers in their mature footprint.
Precisely. They are dominating the new frontiers, but they are engaged in a brutal hand-to-hand turf war in their own backyard.
Which means we need to understand the mechanics of that turf war. Because, the narrative for a long time was that cable internet was a localized monopoly. You had one choice for fast internet, and it was the coaxial cable coming out of your wall. But management was very candid on this call about who is eating their lunch in the suburbs.
Very candid. They pointed to 3 distinct macro headwinds. The first is expanded fixed wireless access, or FWA. This is T-Mobile and Verizon selling 5G home internet.
Right, basically a little box you plug into the wall that pulls a cell phone signal and turns it into a Wi-Fi network for your house. Super easy to set up.
Exactly. The second headwind is aggressive fiber overbuilding. This is AT&T, Frontier, and various private equity-backed regional players physically digging up the sidewalks in Charter's legacy neighborhoods to lay fiber optic cables right past the same houses Charter serves.
Yeah, physical turf war.
Literally digging up lawns.
Yeah.
And the third factor is broader macroeconomic pressure, specifically softer overall moving rates and lower sales among lower income consumers who are just feeling the pinch of inflation right now.
I mean, it sounds like a bloodbath. If you have 5G beams coming through the windows and fiber optic cables being buried under the lawn, it's a siege. But you noted something buried in the transcript that completely changes how we should interpret these losses.
Yeah.
This isn't a mass exodus of angry customers.
No, it's not. And this is perhaps the single most critical operational metric for an investor to grasp today. Management explicitly stated that their churn rate,
meaning the percentage of existing customers who call up and cancel their service every month.
right, their churn rate is virtually flat year over year.
Wait, if churn is flat, how do you lose hundreds of thousands of subscribers?
Because of the funnel. A telecom company's net additions are a simple equation: gross new additions minus churn. Charter's churn, the back door, is tightly shut. People are not rage quitting the service at higher rates than historical norms.
So they aren't bleeding out the back.
Exactly. The problem is entirely at the top of the funnel. The front door is jammed.
So they just aren't getting the new connects.
Exactly. Think about the mechanics of the telecom market. A huge portion of new customer acquisition happens when people move. A college student rents their first apartment, or a family upgrades to a new house. 10 years ago, when they moved into a Charter footprint, they called Charter because it was literally the only option for broadband.
Right, as the default.
But today, when that family moves into a suburban house, they get a flyer for AT&T Fiber, an email for T-Mobile 5G home internet, and a mailer from Charter. Charter is simply winning fewer of those jump balls. Management refers to this as top-of-the-funnel softness.
So basically, the core product isn't fundamentally broken to the point where existing users are abandoning it, but the competitive density has eliminated their default monopoly status for new movers.
Correct. And this brings us back to your earlier point about the mobile strategy acting as a loss leader.
Right, giving away the phones.
Why are they pushing mobile so aggressively if the margins on the rented Verizon network aren't as good as pure broadband? Because it is the ultimate defense mechanism against that competitive density.
Okay, let's talk about the behavioral economics of the bundle, because the numbers here are genuinely mind-blowing. I was looking at the churn reduction statistics. When a standalone broadband customer decides to buy just one mobile line from Charter, their likelihood of churning drops by nearly 40%.
40%. It creates an incredibly sticky ecosystem.
And it gets even more extreme. If that same customer adds a video package to their internet and mobile service, creating a modern triple play, their churn drops another 40%. They are essentially exploiting the psychological friction of the modern utility bill.
Exactly. The strategy is purely behavioral. If you only have Charter internet and AT&T runs fiber to your street offering a slightly faster upload speed for the same price, the friction to switch is relatively low.
Yeah, you just make a phone call, a tech comes out, you're done.
Right. But if your entire family's cell phone plans are tied to your home internet provider and you are receiving a massive multi-line discount because of that bundle, untangling that web becomes a logistical nightmare.
Oh, totally. You would have to port 4 cell phone numbers over to Verizon or AT&T, likely pay activation fees, figure out a new home internet provider, coordinate the installation, all while probably seeing your total monthly telecom spend go up. Human beings are inherently lazy. Once you lock the phone, the TV, and the internet into one discounted ecosystem, the friction to leave is just too high to justify switching for a marginally faster fiber connection.
And management is acutely aware of the massive white space they have to execute this strategy. Currently, their mobile penetration across their internet customer base is only about 20%.
So only 1 in 5 Charter internet homes has a Spectrum mobile line.
Exactly. Management looks at the remaining 80% not as a liability, but as a massive defensive moat waiting to be flooded. If they can aggressively convert those single-play internet homes into sticky mobile homes, they effectively bulletproof their subscriber base against the FWA and fiber overbuilders.
Here's where it gets really interesting. This is where we see a fundamental operational pivot that feels almost counterintuitive for a legacy cable company. They aren't just relying on the logistical trap of the bundle. They are actively trying to improve their Net Promoter Score, or NPS.
Which is huge.
They are trying to make people actually like their cable company, which historically sounds like an oxymoron.
It really does. It is a massive cultural and operational shift, primarily driven by CEO Chris Winfrey. Historically, the cable industry model was built on extraction. You locked in a local monopoly, and then you squeezed the captive audience by raising prices 5% to 10% every single year.
The dreaded promotional roll-off. You sign up for $49 a month, and on month 13, your bill is suddenly $89. And when you call to complain, they basically tell you to pound sand because you have nowhere else to go.
Exactly. But Winfrey and CFO Jessica Fisher realize that model is dead because the monopoly is dead. So they are pivoting to compete on service quality and reliability, not just racing to the bottom on price or relying on inertia.
The logistics behind this pivot are intense. Management highlighted on the call that they are moving to 100% US-based sales and customer service. They are completely abandoning the offshore call center model.
A huge undertaking.
And furthermore, they instituted a same-day service guarantee. The CEO casually mentioned that if your internet goes down, a technician is often arriving at your house within 2 hours of the phone call.
I mean, to execute that logistically, to have the truck rolls optimized to the point where a tech can be dispatched and arrive within 120 minutes across a footprint spanning millions of homes, it requires massive internal investment in workforce management software and localized staffing. It is not cheap.
And they are backing it up with a financial guarantee. They rolled out a $1,000 savings guarantee for new and existing customers who switch their mobile service to Spectrum. They are explicitly telling the consumer, we will manage your entire household connectivity, and we guarantee you will keep more cash in your pocket.
This strategy puts Charter directly at odds with how Wall Street traditionally models telecom companies. Analysts have spent the last 2 decades obsessing over a metric called ARPU, average revenue per user.
Right. ARPU is everything to them.
Specifically, they want to see the broadband ARPU climb steadily every quarter. They want proof that the company still has pricing power.
Because if the broadband ARPU is climbing, the profit margins are expanding since the cost to deliver that data is relatively fixed.
Right. But on this earnings call, CFO Jessica Fisher directly challenged the analysts' models. She told them, point blank, that Charter does not manage the business for individual product ARPU anymore.
Wow. That is a bold thing to tell a room full of equity analysts who have built their entire valuation models around that exact metric. She is essentially saying, your spreadsheet is measuring the wrong thing.
She told them they manage for overall customer relationship value. Charter is perfectly willing to let the broadband ARPU stagnate, or even slightly decline through heavy discounting if it allows them to sell 2 or 3 mobile lines into that household.
Because of the churn reduction.
Exactly. The margin on the individual broadband pipe might compress, but the total cash flow generated by the household increases, and the probability of that household churning drops to near zero.
It is a long-term strategy that sacrifices the short-term optics of margin expansion for structural permanence. They are building a fortress, not a quick-flip real estate project. But defending the fortress organically is only half the narrative of this quarter. Because Charter isn't just playing defense in their legacy markets. They are about to fundamentally alter the competitive map of the United States with a historic acquisition.
The pending acquisition of Cox Communications is the catalyst that changes the entire trajectory of the stock. It is the elephant in the room that requires deep analysis.
Let's lay out the sheer scale of this deal, which management expects to close mid to late August. Charter is acquiring Cox at an enterprise value of $27 billion. Management noted this represents roughly a 5x multiple on Cox's expected EBITDA.
Massive.
Once this integration is complete, Charter will reach 37 million customers across 1.3 million miles of physical network. They will pass over 70 million homes in America.
Just to put that 1.3 million miles of network in perspective, that is enough physical coaxial and fiber optic cable to wrap around the Earth at the equator over 50 times. The scale is almost unfathomable.
It's crazy. But swallowing a $27 billion entity comes with massive execution risk. I mean, you can't just buy a competitor that large and expect the systems to mesh overnight.
No, and this is where historical precedent is vital for investors. We have to look back to 2016 when Charter executed a very similar massive roll-up by acquiring Time Warner Cable and Bright House Networks simultaneously.
That integration was notoriously messy in the early days, wasn't it?
Oh, it was incredibly complex. You were dealing with entirely different billing systems. Some legacy systems like ICOMs clashing with CSG platforms. You had different network routing architectures, different pricing tiers, and completely different corporate cultures.
My headache.
But the executive team that drove that 2016 integration, notably Chris Winfrey, who was CFO at the time and is now CEO, they learned exactly where the friction points are. They built a standardized playbook for ripping out redundant back-office software, unifying the billing platforms, and streamlining the physical network routing.
So they are essentially dusting off the 2016 playbook, but applying it with the benefit of a decade of hindsight. And the financial rewards for executing this playbook are staggering. On the call, management stated they expect at least $800 million in run rate transaction synergies. And Winfrey casually hinted during the Q&A that he actually expects that number to eventually hit $1 billion.
If we connect this to the bigger picture, this isn't just about getting bigger, it's about synergy and pricing power. Let's break down where $1 billion in savings actually comes from, mechanically.
Yeah,
It's not just firing middle management, it comes from network scale. When you combine the backbones, you eliminate redundant peering agreements with transit providers. You consolidate massive data center footprints. You gain immense leverage in procurement. When you are buying fiber optic nodes, amplifiers, and customer modems for 37 million people, you dictate the price to the manufacturers.
But it's not just a cost-cutting exercise. The Cox acquisition is a massive revenue growth play, masquerading as a consolidation play. Management noted that historically, Cox has run a model with higher individual product prices than Charter, but as a result, they have heavily underpenetrated mobile and video segments.
And this is where the behavioral bundle strategy we discussed earlier goes on the offensive.
Exactly. Charter's game plan is brilliant in its simplicity. They are going to walk into a Cox market, say somewhere in the Sun Belt, and they are going to lower the standalone broadband price for the existing Cox customers to match Spectrum's national pricing grid.
Which immediately generates goodwill. The customer sees their internet bill drop.
Right. But in the very same breath, the Charter rep says, hey, since we just saved you $20 a month on your internet, let us port your 2 cell phones over to our Spectrum mobile network. We will cut your current AT&T or Verizon bill in half, and you will still be paying less overall than you were yesterday.
Ooh.
They are taking a stagnant Cox customer base, injecting the sticky mobile bundle, and instantly accelerating unit growth.
It is the exact same Trojan horse strategy they used to integrate Time Warner Cable. And it works because it relies on immediate, visible consumer savings to drive long-term corporate value.
However, buying a $27 billion company requires an immense amount of capital. And this brings us to the most complex, but arguably most important part of the earnings call for retail investors to understand: the capital structure pivot.
Yes, the balance sheet.
Charter has traditionally been a highly levered company. They use cheap debt to aggressively buy back their own stock, but the macroeconomic environment has changed.
Interest rates are no longer near zero. The cost of carrying massive amounts of debt has fundamentally shifted, and management explicitly acknowledged on the call that they have been hearing nervous feedback from both their debt and equity investors regarding their leverage profile.
So they are actively changing course. They announced they are officially lowering their post-transaction leverage target to 3.5 times EBITDA within 3 years. That is a massive signal to the market that they are prioritizing balance sheet health over aggressive financial engineering.
It is.
But they aren't just issuing press releases. They are executing highly complex maneuvers to hit that target.
The liability management exercises they undertook in this quarter are masterclasses in corporate finance.
Let's break down exactly what they did, because it sounds like Wall Street jargon, but it represents pure value creation for the shareholder. First, during the quarter, they repurchased $1.2 billion of their own debt on the open market, but they only paid $1 billion in cash for it.
To understand how you buy $1.2 billion for $1 billion, you have to understand bond pricing mechanics in a shifting interest rate environment.
Right.
Let's say years ago, when rates were at rock bottom, Charter issued a bond that pays 3% interest. Today, if an investor wants to buy a bond, they can get a risk-free government bond paying 5%. So nobody wants that old 3% Charter bond unless they can buy it at a massive discount to its face value.
It's like having a mortgage at 3% when current rates are 7%. The bank would love to get that cheap debt off their books.
Exactly. So Charter's old bonds are trading in the open market at, say, 80 cents on the dollar. Charter simply went into the open market, used $1 billion of their cash, and bought back bonds that had a face value of $1.2 billion. They instantly vaporize $200 million of future liability simply by taking advantage of the interest rate spread.
It is brilliantly opportunistic, but they followed it up with an even bigger move the night before the earnings call. They launched a massive capped exchange offer for $20 billion of par value debt. I need you to explain this mechanic clearly, because this is where a lot of retail investors get lost in the weeds of corporate debt restructuring. What is a capped exchange offer, and how does it pull forward their leverage targets?
Let's stick with the mortgage analogy, but scale it up. Charter has billions of dollars in these older, low-interest bonds that are currently trading at deep discounts. Instead of buying them back with cash, because they need their cash for the Cox acquisition, they are offering the bondholders a trade. Exactly. Charter says to the institutional investor holding the bond, "We know your bond is currently trading at a huge discount because the interest rate on it is so low. We will offer you a brand new bond. This new bond will pay a much higher current market interest rate, which you want.
Okay, sounds good for the investor.
However, in exchange for giving you that higher interest rate, we are going to reduce the principal amount we owe you."
So the investor gets higher cash flow from the interest payments, which they are desperate for in this environment, but Charter gets to officially reduce the total amount of debt on their balance sheet.
Precisely. The total principal shrinks. The capped part simply means Charter is limiting the total amount of new debt they are willing to issue in this swap to protect their interest coverage ratios. This highly complex financial engineering mathematically forces their leverage ratio down without requiring them to burn through billions in actual cash reserves. It accelerates their path to that 3.5 times target significantly.
It is absolutely fascinating to see a management team manipulate the yield curve to clean up their own balance sheet. But as brilliant as that debt swap is, it is not the holy grail of this earnings call.
Far from it.
The true North Star for anyone evaluating Charter's stock price right now is the CapEx cliff and the resulting explosion in free cash flow.
This is the entire thesis. Everything else we have discussed, the mobile bundle, the Cox synergies, the debt swaps, all of it is just runway. The CapEx cliff is the takeoff.
Listen to these numbers carefully because they dictate the future valuation of the company. For the current year, 2026, standalone Charter expects to spend $11.4 billion on capital expenditure.
11.4.
That is money actively leaving the business to upgrade physical networks, lay the rural fiber we talked about earlier, and build out capacity. It is an immense capital drain.
But it is a temporary drain. Management reiterated their guidance that once this current wave of network evolution is complete, that spending is going to fall off a cliff. By 2028, they expect CapEx to dramatically drop to under $8 billion a year.
Let's explain what that network evolution actually is, because you need to understand why the spending is so high now and why it definitively ends in 2028. What physical infrastructure are they actually building?
They are executing a massive transition to DOCSIS 4.0 and high-split architecture.
Let's break those terms down for a sec.
Sure. Traditional cable networks are asymmetrical. They give you massive download speeds to stream 4K movies, but relatively slow upload speeds, which used to be fine before everyone started working from home and joining Zoom calls.
Right.
To compete with fiber optic networks, which offer symmetrical speeds, meaning the upload is just as fast as the download, Charter has to upgrade their network.
But they aren't digging up every lawn in America to lay fiber to every single house, right? That would cost hundreds of billions of dollars.
No, and that is the genius of the DOCSIS 4.0 standard. It allows them to push fiber-like multi-gigabit symmetrical speeds over the existing copper coaxial cable that is already inside your walls. But to do that, they have to physically upgrade the active electronics out on the street.
The nodes and amplifiers.
Yes. They are sending bucket trucks into every single neighborhood in their footprint to physically swap out the hardware on the telephone poles and in the green pedestals on the sidewalks. They are changing the spectrum allocation inside the wire, that is the high split part, to open up massive lanes for upload traffic.
It is a massively labor-intensive, hardware-intensive, physical undertaking. That is where the $11.4 billion is going.
But here is the critical point. Once you swap that hardware, you are done. The capacity of that upgraded coaxial network is so vast that it will handle consumer data needs for a decade or more without requiring another massive physical touch. The bucket trucks park. The hardware purchasing stops. The physical evolution is complete.
And that is the cliff. Once the trucks park in 2028, the spending drops from $11.4 billion to under $8 billion.
Management literally spoon-fed the math to the analysts on the call. That CapEx reduction alone represents roughly $3.4 billion in pure savings.
Let's translate that into per share value for the retail investor. If you take that $3.4 billion in newly freed up cash and divide it by Charter's current share count, that reduction in spending is equivalent to over $30 of free cash flow per share.
Over $30 of free cash flow per share. At the stock prices we were seeing around the time of this earnings call, management pointed out that this implies a free cash flow multiple of just over 2 times by 2028.
Let that sink in. If you buy the stock today and management executes this plan, the company will be generating almost 50% of its total market capitalization in pure, unadulterated cash every single year by 2028.
A 2 times free cash flow multiple is functionally unheard of for a stable, large-cap technology or telecom company. Typically, companies trade at 10, 15, or 20 times free cash flow. A multiple of 2 implies that the broader market completely disbelieves management's ability to pull this off.
The market is pricing in the absolute destruction of the broadband business by fixed wireless and fiber before 2028. Wall Street is betting that the moat will fail, the Cox integration will stall, and the cash flow will never materialize.
This raises an important question. Can you stomach the short-term optical illusions, the noisy headline broadband subscriber losses, and the messy integration of a $27 billion competitor for the promise of world-beating systemic cash flow in 2 years?
So what does this all mean? We promised you an opinionated, actionable stance, and here's our verdict based on the data. We believe Charter Communications is a highly compelling, bullish value play, but it is one that requires an iron stomach and extreme patience.
It is not a trade. If you are buying this stock expecting a 20% pop on next quarter's earnings release, you are playing the wrong game. This is a foundational, long-term investment.
Exactly. To help you navigate this, we have 3 actionable takeaways for how to handle this stock over the next 12 to 18 months. Takeaway number 1, the short term is going to be incredibly messy, specifically regarding the financial reporting. When Q3 and Q4 roll around and they officially absorb Cox, you need to expect the headline numbers to look bizarre.
This comes down to the mechanics of corporate acquisitions, specifically purchase accounting and something called the fair market value step-up of assets.
Explain how that distorts the headlines. Why will the Q3 bottom line potentially look like a bloodbath, even if the underlying business is fine?
When Charter officially acquires Cox, accounting rules force them to revalue all of Cox's legacy physical assets, their trucks, their routers, their cables, at today's current market prices. This massive increase in paper asset value creates a corresponding massive non-cash depreciation expense on the income statement over the next few quarters.
So the depreciation expense balloons, which artificially crushes the net income line.
Precisely. It's an accounting mirage. It is not actual cash leaving the business. But the algorithmic trading bots that scan earnings releases for net income misses will likely trigger automated sell-offs based on that distorted headline. Year-over-year revenue and profit comparisons will be functionally useless for at least 3 quarters as the Cox numbers are blended in.
So the actionable advice is, do not panic when the algorithms dump the stock based on misunderstood purchase accounting headlines. Keep your eyes on the free cash flow and the subscriber stabilization.
Takeaway number 2. Your core thesis rests entirely on holding the line until 2028. If you are buying or holding Charter today, you are making a specific bet that the executive team can maintain the current customer base long enough for the CapEx cliff to trigger.
You are betting that the mobile bundle trap, the 100% US-based customer service, and the Cox pricing synergies are enough of a shield against AT&T Fiber and T-Mobile 5G to keep the revenue stable.
And once that CapEx drops below $8 billion, that massive reservoir of free cash flow unlocks. When that happens, they will resume their historically aggressive share buyback program, which they have currently paused until Q4 of this year to digest the Cox purchase. When a company generating $30 a share in cash starts buying its own stock, the multiple expansion can be violent.
And takeaway number 3, keep a very close eye on the B2B upside. We have spent this entire deep dive focused heavily on the residential turf war, but the Cox acquisition brings massive, often overlooked enterprise capabilities.
The business-to-business segment is a massive margin driver that retail investors frequently ignore.
Cox has incredibly deep roots in hospitality tech. They provide the managed network infrastructure, the in-room Wi-Fi, and the secure routing for massive global hotel chains. Furthermore, they own specialized subsidiaries like Segra and RapidScale, which provide advanced cloud management, cybersecurity, and dedicated fiber solutions for large enterprise businesses.
With a combined national scale of Charter and Cox, they will instantly become a formidable, unified competitor to the legacy enterprise telecom providers like AT&T and Lumen. The enterprise margins are substantially higher than residential, and this could provide an unexpected, highly profitable revenue stream to offset any lingering stagnation in the suburban residential broadband market.
It diversifies their risk profile significantly.
So we have covered an immense amount of ground today.
We absolutely have. We tore apart the illusion of the top-line revenue decline to find the hidden resilience of the core business. We explored the genius of the mobile bundling strategy, the steak and the cocktail, to completely crush churn and lock customers into the ecosystem. We analyzed the massive physical realities of the rural build-out versus the urban turf war. We unpacked the billion-dollar synergy potential of the Cox deal, the brilliant financial engineering of the debt swap, and the ultimate holy grail, the physical network evolution ending in 2028 that unlocks a projected $30 per share in free cash flow.
The mechanics of the story are complex, but the underlying math is heavily skewed in favor of the investor who is willing to look past the noisy headlines and understand the physical reality of the infrastructure.
But before we let you go, I want to leave you with one final, deeply provocative thought. It was a fascinating little nugget buried deep in the Q&A session with the analysts, and it points to a potential future for this company that almost nobody is pricing in.
It's the invisible infrastructure play.
Yes. An analyst asked CEO Chris Winfrey a seemingly straightforward question. Would Charter ever consider partnering with the satellite provider like Starlink to build out a new wireless network to compete directly with AT&T and Verizon on a national scale? And Winfrey's response was incredibly telling. He basically scoffed and said, "Why would we do that? We are essentially already the largest facilities-based wireless provider in the country."
It sounds totally counterintuitive for a cable company that rents Verizon's cell towers for its mobile service to claim they are the largest wireless provider.
It does, until you look at the data flow. Charter currently offloads 87% of all their mobile traffic onto their own existing Wi-Fi hotspots and their localized CBRS Spectrum networks.
Meaning, when a Spectrum Mobile customer is walking around town or sitting in a coffee shop, 87% of the time, their phone isn't actually using the Verizon cell tower. It is seamlessly authenticating and routing data through a router connected to Charter's physical coaxial network.
Exactly. Their wires and their routers are already doing the heavy lifting for the mobile industry. But here is the massive kicker. Winfrey casually mentioned that they're already monetizing this invisible network for third parties. He used Amazon delivery fleets as an example.
Really?
Yeah. Charter offers seamless network authentication for those massive Amazon electric delivery vans.
So as those vans drive through a neighborhood, they are constantly generating massive amounts of logistical data, telemetry, and video feeds.
Right. And instead of Amazon paying exorbitant cellular data rates to transmit that telemetry over traditional cell towers, the vans securely and invisibly offload their massive data payloads onto Charter's neighborhood Wi-Fi networks as they drive past the houses.
Oh, wow.
Amazon saves a fortune in cellular data costs, and Charter monetizes a Wi-Fi signal that is already broadcasting into the street.
The implications for that kind of wholesale wireless plumbing are staggering.
Think about the future of autonomous vehicles. Think about a Tesla or a Waymo taxi driving around a city, recording terabytes of 4K video data from its external cameras for its neural networks. That data has to get back to the servers. It is too expensive to push it all over 5G. Could Charter's ultimate hidden value be acting as the invisible data offload network for the entire next generation of autonomous vehicles, drone delivery fleets, and even rival telecom companies who need to relieve congestion on their macro towers?
It transforms them from a residential internet provider into the foundational utility layer for the automated economy.
And it is a massive potential high-margin revenue stream that Wall Street models are absolutely not pricing into the stock yet. So think about that the next time you're walking down the street and your smartphone seamlessly auto-connects to a Spectrum hotspot without you doing a thing. You aren't just saving a gigabyte of data, you are interacting with an invisible, omnipresent infrastructure that might just make the stock an absolute monster over the next decade. Keep your eyes on the dirt, ignore the noise, and we will see you on the next deep dive.